bring in Dan Deming, managing partner at KKM Financial, joining us to break it down and take a look here. Dan, I know you've only had a minute, not even, to digest this number, but am I correct to have the focus here on that core CPI month over month for August at 0.3, analysts looking for 0.2%?
Yes, you are, Ben. And yeah, especially in consideration of the fact that, the market was leaning offside, I think, a bit based on some of the recent talking points in the last couple of days about the fact that this number is going to come in below expectations. So the fact that the core came in above expectations, yeah, this is going to be a little bit of a challenge to start the day for the equity markets, at least, as it kind of resets the expectations now after this data release. And, I guess this one, if it does, I don't know if it clarifies it, but I guess it strengthens the case that the Fed may only go a quarter, although I think that that's all they should do anyway. But I think that will be the topic probably after this number, is the fact that, this will potentially keep the Fed more geared towards a quarter point than a half point cut that has been heavily discussed going into this meeting.
Dan, talk to me, because we started off the show discussing how, well, short of some major surprise, I said no new information here, but maybe there is some new information here, and it seems to be pointing that the economy is not struggling, maybe to the extent that we were concerned about.
Yeah, and that's the other fact, I think, that you look at, Ben, from a larger picture. It's easy to get lost in the day-to-day numbers, but if you look at it from a larger or longer perspective, I should say that overall you'd say that we're seeing some slowing in the labor markets. The Fed's very concerned about that. That is one of their mandates, so they're going to highlight that. And I get that's the one area where they need to focus now, particularly as, even though with this morning's data, we'll see if PPI follows through tomorrow. But it's not going to be a linear type of move lower, and even at the headline with 0.2, it's still pretty much within the range of the yearly range, Ben. So I think that when you look at the economy overall, it is slowing, but at the same time, I think if you look at historically, when the Fed has cut 50 basis points, we have gone into a serious recession, if not more so, 6 to 8 months later. And, that's another factor I think that needs to be considered. I mean, if the Fed feels the need that they're going to have to cut 50 basis points, that might be a canary in the coal mine that is signaling that things are worse than they are. So at this point, Ben, I just think that, we're slowing. The Fed doesn't want to see it slow too much, but at the same time, it does look like, by and large, the growth prospects are going to keep us above the level of slipping into recession.
We were talking about that earlier in terms of the yield curve and the indicator that provides us in terms of recession to come. But you were talking earlier about how this market, maybe this isn't that big of a deal in terms of a number. It was more, to your point, kind of the market had gotten a little bit over its skis. This is fairly typical of this market, right? As of recent, whether you're talking yields or stocks, in some ways, in terms of anticipation of those rate cuts. But looking at the dollar, looking at yields as of recent, a reflection of that too, right? We mentioned the 2-year, the shorter end, lowest levels we've seen in 2 years.
Yes, yeah, exactly. September of 22, Ben. So, the market's adjusting for the idea that, rates are most likely going to continue to move lower. Officially, they have moved lower as far as when you look at the expectations. And the other thing is this morning, the mortgage data, certainly you look at the 30-year mortgage coming down quite a bit. So that trend is firmly in place. And so, I think the Fed's been very pragmatic. I don't see any reason why they're not going to continue to be pragmatic moving forward. And in my eyes, that would be a quarter point cut, and then probably another one, and then they'll evaluate. But it does appear that they are setting out on a rate cutting policy, not just a one and see what happens kind of scenario that we did get from other central banks. And and if the data continues to come in by and large in line with the Fed's mandates, that will keep them on that path. And this is a little bit of an outlier, but not really that much. Again, I think this is more about the fact that the market was expecting, I think, something much lower than what was already kind of announced going into this announcement this morning.
Dan, oftentimes when we have you on, we talk currencies. We talk about which came first, the chicken or the egg, in terms of the euro influence and dollar yields, who's sort of what's behind the wheel in terms of some of the price activity. I think feel like we're in a similar conversation with crude right now, right? Because it's helping the Fed in terms of easing some of those inflationary pressures, but also a reflection of what they're dealing with in terms of the economy slowing. We've seen it come off significantly now to $65. And again, a reflection of some of those economic concerns. Also, there's other contributing factors here. But talk to us about how, this is, again, one of those similar situations with rates where if this continues, it also sparks further concerns about, what comes next, what's down the road, and the unknowns that the market's sort of telling us.
Yeah, it does. And really across the board in the commodity space, Ben, you're seeing prices coming down to
copper,
some of the lowest,
silver,
coming down to some of the lowest levels in quite some time.
Yeah.
And that's an indication that, again, I think that's an indication that the distribution, the supply chain, other things, that were really disrupted 4 years ago are still, the lingering effects of trying to get things back into balance. That's part of it, I believe. So it's not going to be a smooth path as much as it's much better than it was a few years ago. It's still going to have some disruptions periodically, particularly with the tensions in the Middle East. That's another factor. But overall, when you look at what the global supply is in crude, when you look at the Saudis cutting prices to Asia just last week, there's indications that there's ample supply. The markets have, kind of come back in equilibrium, maybe even a little bit over supplied at this point. And if there's any indication that demand may slow, and it can, again, when you look at it from a global perspective, China continues to struggle. We're seeing other areas slowing. Great Britain, UK this morning, that data was coming in way below expectations. So there is some slowing out there. And if that is the theme, then demand in theory is going to decrease. And I think that's why you're seeing the markets selling off here. But again, just like in cyclical type of patterns, this is a cycle that, will stimulate or create more activity, maybe more travel, maybe things of that nature, because prices are coming down.
Data today disappointing in the UK. That was for the second consecutive month.
Yes.
Analysts were looking for a 0.2% expansion. Industrial output actually fell by 0.8. That was led by 1% drop in manufacturing output. Dan, appreciate you joining us, taking a look at the numbers here this morning. CPI, market reaction to Dan Deming's managing partner at KKM Financial.